Hello, everyone, and welcome to another episode of Wealth of Patience. My name is Angad Gujral, and my goal is to create a community of people who are passionate about building long term wealth. In today's episode, I will be going over corporate America, how the world works, specifically how developed countries such as USA and Canada work, and the corporate structure that we live under. So I really want to give a breakdown into really what a corporation even is. You often hear it in news channels or in people's conversations when people talk about stocks and commodities and dividends and corporations and billionaires and all of this stuff. But what really is the system that we live under? And what are, if you look up ABC News or any news channel, what is the little scrolling message at the bottom of the channel where you just see all these like numbers and ticker symbols or little symbols saying Apple 1.2%, S&P 500 4.5%. What does all of that mean, and what exactly does corporate America mean? So let's start off with the basics. What is a share? A share or a stock is exactly what it means. A share is a part, just like the word suggests. So think of a company as a cake, and think of a share as a very small slice in that cake. So let's think of a company, everybody's favorite company. Let's think of Apple. Let's say the Apple company is worth $1 trillion. That seems like a really big number, but let's break it down. So let's say Apple company is worth $1 trillion. So we can imagine it by thinking of the Apple cake being worth $1 trillion. And how much is one slice of that cake, or how much is one share in Apple? It's $165. So for $165, Apple's net worth is, or market cap is 2.7 trillion. So for $165, you can buy 0.00001% of the company, or a very, very small slice of Apple as a company. So that is exactly what that means. How many shares does Apple have, or how many slices does Apple have? So Apple has about 16 or 16.2 billion shares in their company. So that means there's 16.2 billion little slices of shares. And for $160, you can buy a little slice of that share, or a little slice of that cake. And what you do by doing that, what does it mean when you buy a little chunk of Apple, or put $160 in and buy a little portion of it? You're essentially buying a very small percentage of the company. And why would you do that? Why would you want to buy a little share of a company? You want to do that if you believe in the company, and you want to do that if you believe that cake or that Apple's company or that technical thing would be worth more. If you think, let's say you buy a cake, if you think that cake would be worth a lot more in the future, and a lot more people would want to buy that cake in the future. So yeah, how does Apple become Apple? Now that we've talked about what a share is and what buying a share in a corporation really means, it's also important to go down to the basics and understand as to how a corporation becomes a corporation. Why has Apple got to the point where it's worth $2.7 trillion, which is an unfathomable number, and people are willing to pay $165 for 0.00001% of a company? Why aren't they willing to pay like $160 for 0.0001% of any other company? Like, why has Apple got to this point? So let's go into how a corporation becomes a corporation. And all these big buildings, if you're in any major city such as New York, Toronto, and Los Angeles, any big buildings, like you see all these like big corporations, Apple, Tesla, Google, Microsoft in Silicon Valley, or you see even like financial companies, KPMG, Deloitte. Any of these companies, how did they get to the point? It all started off with being a startup. So the progression for any corporation throughout is going through the startup phase and slowly getting it up to the point. Let's go over the startup process and how a company goes from a little idea in one person's head to a massive empire like Apple or Google or Alphabet. Obviously, this is a very theoretical process, and in real life, it can differ dramatically from company to company. There can be all sorts of different outcomes, but this is the very basic. So, let's say person A has an idea. Let's say I have an idea for a product, or yeah, let's say I have an idea for a product. I want to execute on that idea, but how do I execute on that idea? I need money to execute on that idea. The first thing I do is have my startup. I incorporate my company, get it all incorporated, get the licensing, branding done, make sure that like nobody else can steal my brand image and all of that. First thing I do is financing. I need money to admit or to fulfill my ideas. How do I do that? Your best bet for any startup would be family and friends. So you go to your family and friends, and ask them for funds, and this is called the seed round or pre-seed round. This is called the very first round, where you put in your own capital, and then you put in your family and you ask family and friends around you to put in capital, and in exchange for that capital, you give them a percentage of the equity. And because they're investing at such an early age, and because the company can go to zero, they're only believing in your vision at that point. There's no cash flows, there's nothing to the company. They're believing in your vision, so you give them a large percentage of the equity in return for giving them shares in the company. Okay, so you started off with 100% ownership in your company. You've given out money to a bunch of your family and friends. Now your ownership's left at like 90, 95, 90%, right? And the rest 5-10% is distributed to other people. Now you have the seed round, where you have your friends of your family and friends or other people, outside investors. It's still not public, but there's other people that are wanting to get into your company. You're going to charge them a higher price now because they're getting in at a later price. So let's say the very first round was 10 cents for a share, and you're giving out a lot of shares for a cheap price. Now you're starting to be more pricey with your shares, because let's say if you've started to even tap into your company and start to like make some headway, you get more investors, you charge them a higher price, and you get more investors, you get more money pumping in. Now that you've got more money pumping in, you do another round. So let's say the first round was at 10 cents, then a 25-cent round. Now you're charging people 50 cents for one share. It's still one share. You were selling it for 10 cents before, but you're selling it for 50 cents now. The reason you can sell it for 50 cents now is, let's say you have a couple employees. With the money that you had before, you were able to hire employees. You were able to like do R&D, research and development, like build out the product, all of that. So now you have enough money to like you're starting to make some headway with your company. And now more people want to get in because they're seeing what you're doing and what you're about to do, and where you're headed towards. And then you can start hosting. There's not in today's day and age, we have crowdsourcing and crowdfunding, but you can basically get other people and external investors through social media, through online, through posting it, through on crowdsourcing websites. But basically, you can get the external world at large. Anyone wants to buy, like private investors, of course. But if you're a high net worth individual and you would like to put in a large amount of capital in my company, you can. A lot of times with friends, family, and all of these rounds, you need to put in a large amount of capital, and that's just how it is. Because they don't really need more shareholders. They want few shareholders, but they want more money invested because they can do more with that, right? And then the more money that's being poured in, the more they can invest that into the company. Hopefully the management's good. If the management's not good, they're spending it on themselves, and you have no idea what they're doing with the money. Like they can make all these promises, but you have no idea what they're doing with the money. So they give you all this money, and then you have to build that company up as the founder to a point where you have two goals. There's only two goals to every company. It either IPOs, or it acquires prior to IPO, or it goes bankrupt and the company fails and everybody loses their money. But let's say if it's headed in a positive manner, if it goes bankrupt, or if the company starts losing money and they're not able to raise additional funds, then you're honestly kind of done at that point. Uber was about to go bankrupt just because they weren't able to raise enough funds. UFC was about to go bankrupt at a point. Like a lot of big corporations that we know today, were about to go bankrupt. But yeah, if you're not able to make money and you don't have enough external investors pumping in money, then you're about if you yeah then you go bankrupt, and everybody that's involved in that loses money. The only people that really made money at that point with the company are the employees, because the employees get a fixed salary based on whatever. But the shareholders lose money, the founders lose all their time, capital, everything. You got a couple good experiences, but everything else is gone. And I would say like 90% of businesses fail. And there's a quote about this, about like 90% of businesses fail in their first year, and most businesses fail. Like very few companies ever get to the point where you're being acquired or IPOing. Or IPOing is when you hit the public exchange. So yeah, let's say you've got to this point where you're making a lot of money. You've given up your ownership. So you started off with 100% ownership with one shareholder. Now you have, let's say, 50 shareholders, and you only have like 30-40% ownership yourself, because you've given it all away to other shareholders. And you have a lot of money, like you're making revenues. You might not be making profit, like your expenses would be equal to your revenues, but you're growing your company month over month. Now you're getting to a point where your company's getting bigger and bigger. And usually, I think it depends from exchange to exchange, but usually once the company is big enough, I would have to look at the specific numbers. But yeah, once the company is big enough, you can list that on the stock exchange, New York Stock Exchange IPO requirements. Yeah, you need to, the market value needs to be about $40 million for an IPO in New York Stock Exchange. So yeah, if your company's worth about $40 million and you're doing it a minimum share price of $4 and you have public shares of 1.1 million, then you can do an IPO. So if your company's worth about 40 million at this point, then you can IPO your company, which is when you share your shares, the remaining shares, to the public. And any other shares that are left in the company, you sell it to the public. And at this point, anyone that's been a shareholder throughout can can sell their shares to the public as well. So let's say the company goes IPOs for $2, right? You and all the other people that have been with you from the day one, like since the start, since the very beginning, can now all like exit the stock and make a big buck if the company IPOs. And that's like the reward. It's a high risk, high reward investment. And that's the reward where you're getting paid for taking out that amount of risk on your capital, because it's a zero or make it big type reward. And at that point, once you've IPO'd, you've gone public, is now at this point you're gonna be all over. Stock exchange are publishing you, media articles are publishing you, everybody's talking about you, you're all over YouTube, like you're all over social media, you're all over like mainstream media. At this point, your company's gone pretty mainstream, because anytime there's an IPO, there's a lot of eyeballs on it, right? What was this company? Because most people have not heard about a company, and as soon as it IPOs, everybody starts to know about the company. And they're like, oh wow, like what is this company? Why is it IPOing? Like, let me look into it. And at this point, you're getting a lot of investors getting into your company. If they like your business model, like where it's headed. Here's the biggest pro of the IPO. Yes, you can strike it rich and you can make it big, but now you have a lot of eyes on you. You're in the media presence. You have to do quarterly reports every couple of months, all of that. And you have to deal with all this pressure of people. And then now you're growing your business every year, year over year, and you take it from, let's say, a 40 million IPO company to a multi-billion-dollar company. You hire more employees, you add more divisions, you expand internationally depending on the business. You keep adding more employees, you add more layers to the company. So it started off as a startup. You probably have like the difference between an intern and the founder. There isn't that big of a difference. Like you can still talk to the president. The bigger the corporation gets, the harder. There's more of a bureaucratic process. Like there's a massive difference. There's like 10 layers before you get to the president. And yeah, you're building more businesses. You're adding more to the company, and you're building it to a massive empire. And at that point, like let's say once you've breaking out to like the couple $100 million in revenue, at this point you can start to acquire other companies. If there's any other smaller company that you like the idea or you like the vision, or there seem to be a market, like a competitor to you, you can buy those out, right? And you can really build your company out to be a massive, massive empire, like a multi-billion-dollar and then $1 trillion empire. Alphabet has been one of the best companies in terms of acquisitions. They'll literally acquire every AI. They've acquired a lot of AI companies, and recently in the metaverse, like they've been pretty intense with their investments, and they just seem to be up. They just seem to be buying up every metaverse company that's making any kind of breakthrough in the industry. So yeah, like once you've made that point, you have a lot of eyes on you. You have a lot of investors. You have millions and millions of people that are looking at you as a founder, and you have all these eyes on you, and it puts a lot of burden on a lot of people. There's a reason why Jeff Bezos recently stepped off as CEO. He started off Amazon literally exactly as this process. He started off as a in his little desk in his room, 1998, and started off as like a book selling books online, I believe, and turned it into this massive empire today. And people always like talk bad about billionaires, and I completely understand why. Um, but yeah, he was able to build that empire out, and the fact that there's a lot of eyes on him now gives people that right to kind of talk bad about him or criticize his action or any of that. A lot of big companies that exist that are private, there's so many companies that are very extremely big and are private. People don't say anything about that. Mars, for example, Mars is a family held private company, and it's one of the biggest companies on earth. Um, it's an extremely big company, but nobody ever really talks about the Mars family in that much detail just because they're not public and there's not that many eyes on it. But yeah, so you build that corporation out to be a massive corporation. You have more employees, you add more layers, and you get more investors, and then you start to sell off your shares that you've had since the founding of the company. And that's kind of like the very basics of how you build a massive like corporation empire. Obviously, there's a lot of sweat, effort, time, energy, a lot of politics, this, that, lobbying, like so much that goes into it. But like that's basically a lot of the stories of how billionaires become billionaires. If you see any of them, no, but none of them have been worked a job. They've all like either founded a company or taken over a company at a very starting age of the company, and then build it up to be a massive empire where they themselves, just because they own stocks in that company and a large amount of it, they're billionaires. Like if you own 1% of Apple, you're a billionaire. No, you're you own about if you own 1% of Apple, you own about $20 billion worth of their stock. Yeah. So like if you own even like 0.05% of Apple, you're a billionaire. Like you have $1 billion worth. But yeah, that's basically how it is. If you're able to retain your stock for that amount of time, and you're able to own shares of a company for 30 years, 40 years, and really have it from like the days when it's like a nobody or nobody knows about the company to when it's a massive brand, and you have the patience to hold on to it for that long, you truly deserve the amount of success that you have, because you have a very high amount of patience and tolerance. Warren Buffett is a very big proponent on it, and he owns shares for like 20 years, 30 years, and most people don't have that type of patience. Or people who are in Tesla right now, who have owned Tesla since 2015, 2016, like they have an extreme amount of patience. And if you have that type of patience, then you definitely deserve any success that's thrown your way because of owning that stock. And I really commend founders and billionaires, like startup founders that turn into billionaires, for that reason, for being able to like persevere their dreams and ambitions and all of that for that amount of turn. And there's a famous quote about Jeff Bezos being like, he doesn't make money for himself. He talks about obviously he's gonna say this, but he says like, I don't make money for myself. I make money for my shareholders, because he only owns like 3% or 10% of Amazon, and he's like, most of the money is made for other people. But like that's kind of how corporations is. The bigger the company goes, the less you own of it. But even if you own like a very small percentage, just because you have such a big corporation, it's worth a lot of money. But yeah, that's a very simplistic version of a breakthrough of how corporations become corporations. So any building or anything that you've seen, any big corporation you see out there, most likely they've all started off from a simple idea in some person's head, from one person's head, and it turned it out into a big, massive empire. And yeah, I think that's the beauty of the corporate world. And people talk about, yeah, like there's inequalities and all of that, but that's essentially the essence of how it is, where virtually based on how it's worded, it's like anyone can have a startup and build it out to this empire. But obviously, as we all know, there's very few winners and a lot of losers. Yeah, that's about it. I hope that provided a lot of perspective into understanding how corporate world works, or how the corporations become corporations, and how these big companies with hundreds of thousands of employees turn that way. And that's pretty much it. And I am looking forward to talking to you guys very soon. I hope you were able to learn something about corporations, how it works, how startups work, what a stock is. I hope you like the cake analogy. And I will see you in the next episode. Peace out, guys. That's a wrap from me.